be a bigger mistake. I think when you look at a 2% real greater growth in the economy, an inflation rate that's running about 2.5%, you're looking at 4.5% neutral rate from a nominal Fed funds rate perspective. And to me, where are we right now? 4.5%. I think we should be ending the year closer to 5% because I think inflation will be 3%. And I think the only reason why you haven't seen inflation from tariffs coming through is because in this environment, while there's negotiations going on, a lot of CEOs are sitting there saying, I'm not going to be the first one to move to raise prices because I don't want to lose market share. I pre-inventoried a lot of stuff. I've got time, I've got opportunity. Let's see how this plays out before I make any decisions.
Well, we would certainly agree with you in terms of the inflation assessment. We also took a look at that and said, yeah, I mean, you're not going to get negative goods prices month over month on a persistent basis. But I do want to kind of drill into this idea of Goldilocks and how long it can persist, this equilibrium, particularly on the labor market side, because what caught my eye last week was continuing claims, which continue to rise. Just those cracks under the surface. Do you see those as a concern? Is there anything there for the Fed to be worried about?
Claims and continuing claims on a 4-week moving average are at exceptionally low levels. When you look at them at covered employment, they're even at a lower level. There's no risk whatsoever in this labor market, and I think that's the key. I think if you're looking for one market where there's potentially a movement out of equilibrium, it is the labor market. But that is only a move towards a tighter labor market. Okay, once you get this tax cut done, and this tax cut I think will be bigger than anyone still currently thinks, I think you'll wind up seeing with a much tighter labor market and a much greater push on inflation. And therefore I question whether or not the Fed's going to get the so-called 2 rate cuts out this year.
So you think that maybe the Fed's not going to cut? Is that kind of your call?
Our call has been the Fed shouldn't cut whatsoever, and therefore we believe the Fed won't cut.
So there's a question here about longer-term bonds and how that really bleeds through at a time when people have not seen this as a haven. And there's been a real question about the inflation risk being priced in or not. And I'm just wondering, do you see yields going higher from here with questions about U.S. assets as a haven, as well as potential inflation that's only exacerbated potentially by inefficiencies and oil shocks that might come up along the way?
I mean, I think we're supposed to get to 5% on the 10-year note. I don't think that's a disaster. When you look at what's happening in the BOJ market, for example, they're having a significant amount of problems there as yields rise in Japan. You look at Europe. European rates probably aren't going to go up because Europe's a mess. And Christine Lagarde doesn't think she needs to cut interest rates, and she does. So I think you've got this situation. Well, I'd rather buy Europe because Europe's more likely to go into deflation than buy the U.S., where we're likely to have 3% inflation. So I don't think we have to get beyond the macro into this geopolitical concern about, solvency and sovereignty and all this other garbage and reserve currency to explain what's happening in markets. What's happening in markets is you're reflecting relative interest rate differentials based on relative inflation differentials and relative real growth. And there's nothing that's mysterious about this. It's traditional macroeconomics.
So we're continuing to work through one big, beautiful bill that's going on underneath all of these headlines that we've been dealing with. And I was curious, the way I think about deficit expansion is there's deficit expansion and then there's fiscal impulse. So some of the improvement or deterioration in the deficit is a function of just extending the tax cuts, which isn't necessarily a fiscal impulse. How do you differentiate between the two? And you mentioned already that you see the risk is actually to more fiscal impulse and more deficit expansion from here.
Yeah, no, I agree with you. I mean, if you were just going to extend the tax cut alone, you would not have a major positive impulse into the economy. But we're not going to do that. And I think the interesting thing is all this stuff is going on and the bill is working its way through the system without the news oversight to it that it would normally deserve to get. And this is what happened when suddenly the House passed the bill, okay? When it came out of committee in the House, suddenly people woke up, oh my God, it's not just extending, the Trump tax cuts. And I think, this is part of the process. It's how the bill is getting done as quickly as it is. And I still think their game plan is to get it done by July 4th and have it implemented by October 1, so they could have a full year of real tax cuts coming through the economy going into the November elections. And I think that's the game plan here. I think the game plan is tariffs are the diversion to get the tax cut. cut. Tax cuts are the reason to get the midterm. The midterm is to get to what they really want to do, which is drain the swamp.
Well, this is what we're going to try to focus on as we parse through all the different risks that are coming up and dominating the news. Steve Ricciuto of Mizuho, thank you so much for being with us. Kelsey Barrow of JP Morgan Asset Management, thank you so much for being with us for the full hour with some fantastic insights as markets shrug off a lot of risk, try to get some sort of rally underway. Coming up next, we'll parse through that with Dan Skelly of Morgan Stanley, Henrietta Trays of Veda Partners, Riyadh Air CEO Tony Douglas, don't miss that, and Earl Davis of BMO as the potential risk for rates very much front and focus ahead of that Fed meeting. This is Bloomberg Surveillance. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
It's 100 years